Hello traders, welcome to ABS. Today I'm going to share a strategy for expiry date only for Bank Nifty. So without wasting time, let's get back to the topic. If you are watching this channel first time, so I request you to kindly subscribe the channel and hit the bell icon. So whenever I will upload my new video, you will get the notification. See, I have back tested this strategy for last 5 to 5.5 years. So first of all, let me show the strategy. Let me tell you the strategy. Let me open the pen tool. So just hold on. Okay, fine. So this strategy is only for Bank Nifty and we will deploy this only on expiry days. The strategy is we will create straddle, we will short straddle, we will short three straddle, right? Straddle is when you're shorting ATM call and ATM put, that is straddle, right? So we will short three straddles on a different time frame with a fixed stop loss. So first of all we will short at 9:30, second schedule we will short at 10 o'clock, and third schedule we will short 10:30. The logic behind this is that on this is the expiry date. So if the expiry is non-trending, then we will get the benefit from both the legs, and if it's become trending, then also we will get the benefit from the trend following. This will act as a trend following, but it is like, but if this is volatile, because very few days are volatile in expiry, mostly we have range bound expiry, or we have till 11 we have range bound, after 12 or 12:30 we got some direction movements, right? So like only 20 to 30% time we do have some volatile expiry on this, on which we have some random spikes on both sides. So we will short three straddle 9:30, 10 and 10:30. The stop loss we will that will deploy, the stop loss will be 20%. We will deploy 20% stop loss on each leg. Say suppose we have shorted at 9:30, Bank Nifty was around 35,000. This is just for an example. So what we will do, we will go and we will short 35,000 call and 35,000 put, and we will simply put, suppose we got the premium of say 150 and 140, right? So in this we will just add the 20% stop loss. So 150 20% is 180, right? And 140 20% is 168, right? Let me check again. Yeah, 168. So what we'll do, we'll just put these stop loss in our system. For 150 premium we will put 150 SL, and 140 premium we will put 160 SL. And this SL is like, if one side SL got hit, then we don't have to change the SL for the averaging side. We will just let the trade run. We will just wait and trade, right? So we will not disturb the second leg. We will put the same SL like 168 only. So one, if the market is non-trending, the both the premium will get decay and we will get the benefit. If it's become trending, one side stop loss will hit and we will get the benefit from the second leg, right? Because 20% very nominal, right? If you see this in this scenario, we'll get only 30 points loss, and if market become trending, we will gain almost 140 points. So 110 point we will gain in single lot, right? So we will deploy three strategies: 9:30, 10 and 10:30, right? So let me show you one example also, and then I will show the back testing data. See, this is the last expiry example. This we will deploy on based on the futures chart, because I have back tested it on stock mock. So they, I believe they take the spot, they take the they take the value of index from future only, right? So we will deploy this on based on the future chart. See, this is the 7th of July. Recent expiry was 7th of July. We will deploy at 9:30. We will deploy the first straddle at 9:30. So 9:30 candle will be, as soon as the 9:25 candle will be closed, the system will take the entry, right? So 9:25 closing, that is almost 9:30, right? So 9:30 closing is 34690. For rounding, it will become 34,700. Here also you can see that 9:55, then 9:55 candle closing, the time will be 10 o'clock, right? So closing is 34,650.1, right? So from the rounding itself it will become 34,700. And here also you can see 9:25, that 9:25 closing will be 10, sorry, 10:25 closing will be 10:30. So here the closing price is 34720. Again the straddle will be 34,700. So in this case I have a, you can see these are the chart of 34,700 call and 34,700 put of 7th of July, right? 2020 22 July 07. So this means 7 July 22, right? So here you can see I have mentioned like at 925, this at 925 closing the we will take the premiums. I just we need to do this from algo also. If you are doing manually, so there will be some variation of the premium, but if you are doing taking the help of any algo, so as soon as the system, like as soon as that is clock shows 10:30, the system will generate the entry, the algo will take the entry. So here 925 closing candle will be, the time will be 9:30. So you can see the premium is almost 94.35. For simplicity purpose I have mentioned 94. Here also you can see the premiums are 72.2. Simplicity purpose I have mentioned 72, and here 95, right? Similarly on the put side you can see the premiums 192, 207, 157, right? So see, on first of all the market was trading in a narrow range, and then we got a breakout, right? So once the market breach our like this highs levels or day highs levels, and then we go to see some momentum. We go, though we get some fall, but at soon, because this is the expiry day, so premiums generally ATM premium will decrease fast, right? So here you see we got just some up move, instant we got a reversal, and in the calls puts premiums you can see some spikes also, right? But that spike was very nominal because we have shorted from the day morning, like 9:30, 9:25, sorry, 9:30, 10 o'clock, 10:35, right? So in this we have, in the I have mentioned the SLs of SL 934. If you do take the SL from 924, if you do 20% of 924, it will become 112.8. So I have mentioned the stop losses over here. You can see these are the stop loss from these premiums: 930, 10, 1030, and here you can see these are the stop loss of these premiums: 192, 207, 157, right? Let me show you. So you can, here you can see the premiums is 157.20. Here you can see the premiums is 207.40. Here you can see the premium 192.45. So I have mentioned the premiums value over here, and the stop loss, if you do 192 20%, it will become 230.4. So here the conclusion, the loss points we have in the call, we have made loss on the all the three legs. The first 9:30 we have lost 18 points. At 10 o'clock we lost 14.4 points. At 10:30 we lost 19 points. So overall we have lost 52.2 points. That is almost, for per lot, if you calculate, that is almost 1300 rupees per lot, right? Now come to the put side. Here we gained, see, no, not a single stop loss got hit. The 192 stop loss was 230.4, and this is the high of the candle of 955. The high is 221.5. Our stop loss was 230.4, so it's not breached. So ultimately we gained the entire premiums. See, you can see at 9:30 we gained 192 points. At 10 o'clock we got 207 points. At 10:30 we got 157 points. So overall we have collected 556 points. In the, if we multiply, it's a lot, it's almost 39,000, 13,900 per lot, right? So overall if we calculate 13,13900 minus 1305, that is almost 12,500 rupees per lot, right? So then this type of moves, you see, we need to deploy the strategy based on the future price, right? If you check the spot price, that time the spot was indicating 34,600. So if you go and check the chart of 34,600 strategy, so you will see the once 930 stop loss got hit, right? So we will do this on based on the future chart, right? So here you can see we get the profit of 12,000 rupees per lot. This will only help you, this will help you on both the conditions, either market trending or market sideways. It will give you stop loss on both legs when market is volatile on expiry days. Fine. So now let me show you the entire back tested data for last 5.5 years. So long. So here's the data. You can see this is the data. The data is from 5th of Jan 2017 to, you can see we have all the Thursdays, 5th Jan 2017 to 7th July 2022. right? So we have data from last 5.5 years. So here you can see, out of this we got 273 dates, 273 expiries. Out of 273 expiries, we have the winning days was 180. We won on the, like, we our trade was in profit on 180 days, and we were in loss at 93 days, right? So overall, if you see, calculate, the win ratio is 66%, so it's more than 60% accuracy, and the loss ratio is 34. And the maximum one day profit is 16,129 rupees, and maximum one day loss. See, these kind of days you have to look at. When the market become very volatile, it will hit your both the stop losses. You can't do anything, right? So for the, you can see the maximum stop loss, maximum profit of one day is 16,000, and maximum loss is 688k, right? And average loss on the, like, average loss, if you calculate, that is almost 2200, and average profit of per day, if you calculate, that is almost 3400. Here you can see the ratio of maximum loss one day and maximum loss profit one day. It's almost 1:2. 8,000 loss, 16,000 maximum profit of per day, right? Now let's we just look at the drawdown. How was the drawdown of last 5.5 years? So let me show you this. Okay, fine. So here is the entire data. The see you we have deployed this strategy from like 75,000 rupees, right? Earlier there was like you were to trade from the low margins, but still if you go and take this on expiry days, if you take 1 2 rupees 2 rupees premiums, then you will get this margin, right? Then you can trade straddle at 75k only. So still depends on, like, on VIX also. For simplicity purpose, I have taken 75,000 rupees per lot, right? So now you can see this is the entire data, and here you can see the peak equity value, like from the, like, the peak equity value, our total, from the total profit, what was the peak profit? The peak profit was 4,84,900 rupees, right? From 75,000 rupees till 5.5 years, you can see years 5.5 days, 2000, sorry, 2001 2012 days, right? So then is we are doing this only on expiry days, but this is counting the entire days from, say, 5th of January. So if you count the entire days, that is almost 2000 days, right? And the years data 5.5 years. So from 75k we have, the ROI is like almost 500 plus percent. You can see the ROI is 500 plus percent, and the maximum drawdown, this is the main important thing which you can't miss. The maximum drawdown is in the value term, it's almost 20k, right? 19,500. So you have to prepare yourself that the maximum drawdown of this strategy is almost 20,000. If you are like comfortable with this risk, then you should deploy this strategy, because the results are perfect. If you see the expectancy ratio, it's almost more than 1 plus 1, right? So this is why a very high accuracy setup. The expectancy, the strategy expectancy is almost 1 plus 1%, and the maximum drawdown is like, in percentage term, is 5.27, almost 5.5%. We have the maximum drawdown from the peak. This is calculating maximum drawdown from the peak. Suppose you started from 75,000, right? 75,000, again you got, this is, see, we breach a peak, say this is 4 lakh 84, right? This number is this, and from this maximum peak, maximum drawdown is 19,000, 90,500 approx. So this is, and now we are heading upwards. So from peak to the bottom, this is called the drawdown. Like how from the peak, how much our PNL effects, and how much we did, how much day we got below, right? So this is almost 19,500. So this is the entire strategy data, and you can check yourself. We have, I have mentioned, like, winning days and losing days, and maximum profit per day, maximum loss per day, average profit per day, average loss per day, and maximum drawdown amount, peak of the equity. The strategy is very simple. Again, what we do, we just need to deploy 3 strategies on expiry days. One 9:30, second 10 o'clock, third 10:30 with 20% premium stop loss. And once stop loss of any leg got hit, we won't change our another leg stop loss. We will just wait and trade with the same stop loss. So this was it, guys. If you do like this video, if you do like the content, do like this video, and if you are not member of our channel, do subscribe this channel. Thanks for watching.